Okay. Good evening, everyone. My name is Becky Thompson. I'm the director of the Kentucky Beef Network, and we're happy to have you with us tonight for our second legal planning webinar with our partners Steptoe and Johnson. Tonight, we're going to be talking about planning and protection, and we have with us Candace Smith and Mike Burrell with Steptoe and Johnson. We're happy to have you all with us this evening. Candace, if you want to give you all or do a brief introduction, and we'll go ahead and get started.
Sounds great. Thank you, Becky. And thank you, Becky and Nikki, for all your hard work in putting this together. We really appreciate it. We're excited to be here with you tonight. As Becky said, my name is Candace Smith. I work with the law firm Steptoe and Johnson, and Mike is one of my colleagues who has jumped in to help us out tonight on some specific estate planning and wealth management issues. For those of you who were not at the webinar last month, I presented with my colleague Laura Mays on potential liability for injuries that could be caused by animals, both on and off your farm. And that webinar was recorded and is available if you'd like to watch it. And then we'll be having some more webinars again next spring. Just a little bit about myself. I grew up in a small town in Western Kentucky, and so many of my friends and family members either worked on farms, owned farms, or at least had, a really big garden in their backyard. So fresh food was always, available and local, and I definitely appreciated that. And I think my passion for local food and for our farmers were developed at that point from a really young age. And so I wanted to be able to find out how I could help farmers address some of their legal concerns, both concerns that might be keeping them up at night or concerns they didn't really think about, but they need to be aware of, such as some of these estate planning issues we'll talk about tonight, just to take those things off your plate so you can focus on what you're passionate about. So I live in Lexington now. I work in the Lexington office of Steptoe and Johnson. We also have a Louisville office, and we serve people all across the state. And in addition, we have offices in about 13 other cities and several states. And one of the best things about working for this firm is that we have a great sense of teamwork and camaraderie. So Mike works, he's based in our Morgantown office, but works a lot in our Ohio office in Columbus and also in our Louisville office. So he'll be able to address some of the questions that you have. And if you have further questions, either of us would be happy to talk to you after the webinar. And I'll pass it to Mike to do a little introduction too, and then we'll get started.
All right. Well, thank you, Candace. I guess I'll be the presenter here. I head up our corporate services and tax practice group in the firm. I've been practicing for 20 years doing estate planning, estate administration, mergers and acquisitions, a lot of business planning. Most of my clients are, closely held, family held businesses. I deal with the estate side of things, but as part of that, especially with business owners, your estate practice lends itself to businesses that they own, asset protection, concerns about being sued, how to hand those assets down a generation, what's the best structure to deal with that, what if you've got one child working on the business and the other child not, how to divide the assets up in a fair and equitable way. But so I deal with these kind of issues on a daily basis. I have, kind of run the gamut from, selling large corporations to setting up small entities to doing an ESOP that I'm meeting with a client next week up in Columbus on an employee-owned company that will be set up, and kind of a nice way to get wealth out for the property owner or the business owner, but keep the same management in place. But that's a little bit about me.
Well, thank you. Tonight we're going to talk about estate planning, land transition, and wealth management issues. And we're going to do it kind of a Q&A format throughout the whole presentation. And then at the end, if you've got questions, you can type them into the chat box as we talk tonight, and then we'll go through some of those questions as well in case we don't answer everything during our main presentation. So before we get started, we sent out a survey a few weeks ago, and we really appreciate everyone who responded to that. That gave us some helpful information for planning our conversation tonight. And one of the things that we noticed was that most people who responded were either in the growth mode or in the nearing retirement phase of their business. And I think what we'll discuss tonight will hopefully be helpful to both groups and people that are in between those two groups. But I think it's important to consider both these issues as you're in the growth mode, how you want to structure your company and what your long-term goals are, or if you're nearing retirement, how to best get ready to pass on your business, like Mike mentioned. So one of the other statistics from that survey was that most people who responded did not have a thorough and written estate plan. So Mike, what are the elements of a thorough written estate plan?
Well, there is no kind of normal estate plan. I guess let me ask one thing before we kind of get into the substance. Can you see me? I'm used to on Zoom calls seeing my face when I'm talking, but Candace, you're still showing up on the camera. So is people seeing me, or is they're still on Candace?
I can see you.
You can see me? Okay, then maybe just this connection. But so bottom line, there isn't a normal, typical, traditional estate plan. It's unique. Every family is unique. Every set of assets are unique. So there's really not anything that's standard. Now, I've got certain documents that I would recommend for every single estate plan. And those documents go from, a living will to powers of attorney, which are considered advanced directives, to a will and trusts. You can get really sophisticated. You can get into insurance trusts. You can get into dynasty trusts, multiple generation trusts, offshore, or even different jurisdictions. We go into Delaware a lot, and Nevada is another good state with respect to setting up a trust because they've got some asset protection planning going on there. And they've also got rules that those trusts can last in perpetuity. Some of the documents you're going to want to make sure you have are a living will, which is basically a statement of your intent if you are in a kind of persistent vegetative state. That's just a statement of your intent in the case you're there, and it makes the person who is having to pull the plug or deal with issues easier. It's a statement that you want them to withhold nutrition, withhold hydration, to pull the plug if in the event you are in that vegetative state. That's not the same thing as being, terminal or being, in a coma or unconscious. You truly have to be in a vegetative state, and you truly have to have 2 or 3 different physicians that kind of state that. In my documents, one of them has to be a neurologist. So that's one of the advanced directives. Then you're going to need 2 different powers of attorney. One is your medical power of attorney. That is the power of attorney for someone to make healthcare related decisions for you. They will set up your care. They will decide on your care. They will deal with the insurance. They will deal with any kind of federal benefit. They will deal with hospital administration and doctors and nurses. Then you have a separate power of attorney that is one that is more financially driven. It covers the management of your assets. It covers the payment of your expenses. It covers any kind of pecuniary issue that you might have. So filing a tax return, cashing a check, paying a bill, all those things tend to be done by your financial power of attorney. You want to make sure you have those documents. They're very straightforward, boilerplate documents. Nobody should be charging you that much money to do them because they're very easy and they're all about the same. But I'm in the middle of a situation right now where we've got a husband and a wife. The wife had a stroke, is now incompetent. The husband is elderly. They've got a significant amount of assets, but they don't have a power of attorney. And they don't have the ability in that power of attorney, because they don't have one, to make gifts. So we're having to go to court, spend money to get a conservator or guardian appointed just so someone can deal with the assets. On top of that, we're going to have to file a motion with the court to authorize us to make gifts so we could potentially do some Medicaid planning, if you will, or at least to talk about, transferring some assets down a generation to let, hopefully preserve some of those assets in the event one or both of them have to go into a nursing home. So those advanced directives are really no-brainers. In addition to that, you're going to want to deal with a will, which is basically your testamentary document. It's formal. You're going to have witnesses that watch you sign it. You're going to have a notary. You'll basically, in your will, at least in most of my situations, everything is what I consider a pour over will. It gets poured over into a trust, and then the trust kind of manages your disposition of your assets. So if you've got a will that leaves everything to the trust, your will appoint an executor, it will waive bond. But as far as the real meat and bones of your estate plan, that will be in the trust. Your trust is easier to amend. You can do that with just a signature and a notary. You don't need to have witnesses. You don't need to have all the formalities. And additionally, with respect to the trust, you can keep things private. It doesn't necessarily go on as public record. So your will becomes public record. Everybody gets to take a look at it. But with the trust, you can maintain some privacy with that. And then your trust will get into whatever provisions you want, whatever fits in your family, whatever fits with your assets. And, it'll also have whatever tax planning provisions you need to make sure you qualify for whatever exemptions or credits or deductions are out there that you would qualify to avoid or minimize paying any estate tax. Those are your basic documents in an estate plan. The other things that you're going to want to consider in an estate plan is, really what do you want to accomplish? What's your objective? I think that's generally the first question I ask clients that come in and I sit down and talk to them. A lot of them want to save taxes. A lot of them, don't want to go through probate. A lot of them want to keep things private. They don't want their neighbors knowing what they have. These are very common concerns that everyone has. But to me, the most important thing is you tell me what you want to accomplish, how you want your assets to go down to your family members or the next generation or generations. It's my job then to tell you how to do it in such a way that minimizes your taxes and keeps it as private as you possibly can. So understanding that, then you're going to have to consider all of your assets. Some assets are controlled by your will and trust. Things that you own yourself are controlled by your will and trust. But if you own something jointly, I would venture to say most of the people on the call or on the Zoom meeting own their house or their residence joint with right of survivorship with their spouse. No matter what your will says, no matter what your trust says, if you've got a deed that owns property with right of survivorship, that's going to trump it. It's going to dictate how the assets go, and they will go to your spouse. Same with beneficiary designations in life insurance or retirement accounts. You can do all the sophisticated planning you want in your will and in your trust, but if you've got a beneficiary designation that doesn't take that into consideration or doesn't connect with one overall plan, then you're going to have different assets going different places, and it's not going to be uniform. Along the same lines are payable on death accounts, transfer on death accounts. I don't know if you're familiar with them or not. They're becoming popular with banks. They tend to want you to do a POD or a TAD. That's basically just a beneficiary designation on one of those accounts that at your death, it goes to the person or persons that you leave it to. And if you name 2 or 3, a lot of my clients come in with their kids' names on those accounts. If one of them predeceases, does it go to their kids or does it go to the other living kids? Most of my clients want that to pass down by blood to the next generation, to their kids if one of their children are predeceased. A payable on death account will generally go to the other siblings. So it just depends on the contract you sign with the bank, but it's just a good example of making sure you're thinking of these other types of what we call non-probate assets that aren't controlled by your will, aren't included in your probate estate, but get passed down through another mechanism, whether it's a beneficiary designation form or whether it's by operation of law. And your big ones are, again, life insurance, retirement accounts, and now, these PODs, and they are on investment accounts and they're on checking accounts. So they're out there.
Thank you, Mike. We also had from our survey, most people responded that they were interested in learning how to preserve and create multi-generational wealth. And you touched on this some with the last topic, but let's get into a little bit more detail for those people who are interested in preserving multi-generational wealth. What are the main things that they need to be doing?
And that's tough because it just depends on the size of your estate and what the unified credit is. So now I'm talking a little bit about estate tax concepts. And I would imagine most of the people in the audience or watching this right now are familiar with the estate and gift tax. If you're not, I don't mean to talk above your head or below your head, but bottom line is there is a tax on every transfer of any asset you make. Theoretically, if I were to give Candace, a mouse pad here that's worth $5, theoretically that's subject to tax. We all have what is called a annual exclusion, which means that the first $15,000 of assets that you give to anybody is excluded. You don't need to file a gift tax return. You don't need to file an estate tax return. It's just basically a freebie. And that's designed to cover gifts, birthday gifts, wedding gifts, all those kind of things. So you have an exemption and exclusion from that for the first $15,000 to every single person you give assets to. Above and beyond that, if you give somebody more than $15,000, if my mouse pad was worth $20,000 and I gave it to Candace, I would have to file a gift tax return to tell the IRS that I gave her a gift in excess of the $15,000. It's a reporting requirement. There's no tax due because in my example, the mouse pad is worth 15 or worth 20. I have an annual exclusion of 15. That leaves 5. That goes against my lifetime unified credit. So right now we all have a lifetime unified credit of about $10.4 million. So we're actually $11.4 million, excuse me. So we've got significant credit to transfer wealth. So you can do that. You can use that during life or you can use that at death. And the way the system works, they're kind of sister taxes in the sense that if you make those transfers during life, you have to report to the IRS and they keep a running tally. And then when you die, you have to add all of that up, plus all your gifts, plus whatever you die with. And if you have more than your unified credit, in today's numbers, 11.4 million, you have to file an estate tax return. And everything above that $11.4 million that you give away is subject to estate tax. And that tax is a marginal rate, but just for ease of discussion and calculation in your head, think of it as 40%. So that gives you a ballpark on what's subject to tax. But a husband and wife can protect in excess of $20 million of assets today. That's kind of a little bit of a background on the estate and gift tax. And that really isn't responsive to Candace's question because that's a tax going down one generation, but you need to understand those taxes before I can mention the real kicker, which is the generation skipping tax, which is another tax on top of the estate and gift tax at another 40%. So you could be taxed at 80% if you find yourself subject to both the estate tax and the generation skipping tax. Estate and gift tax is taxed on every single transfer you make. Generation skipping tax is only taxed on transfers of assets or wealth more than one generation below you. So if you're looking to do something and set things up for multiple generations, you need to be cognizant of the generation skipping tax. Ideally, what you would want to do is transfer assets that are below the the GST exemption amount, which is the same as the unified credit, which is 11.4 million per person today. And then you would use a trust and hold that for multiple generations. And then you would effectively allocate through a gift tax return your generation skipping tax exemption to that transfer. That's how you would effectively do a transfer for multiple generations. You would want to use a trust. You would want to use a trust that has provisions in it that kind of take into consideration the generation skipping tax. And you would want to make sure that you allocate the GST exemption to that. It's very sophisticated. It's confusing. It's expensive. The majority of my clients try to plan their estate planning around one, taking advantage of it, but never actually incurring or being subject to it. So you've got to be smart about it, but that's out there. And if you're making multiple generation transfers, you need to be aware of it. Not completely responsive to Candace's question, but just so you know, right now we're at 11.4 million. The estate tax and gift tax is an extremely, if not the most political tax, at least in my opinion, out there. It's going to change. How much it changes, I think depends upon, where this election lands. Biden's proposal is to take that down to $3.5 million. So you now go from a $23 million credit for husband and wife to $7 million. And that theoretically can include life insurance, retirement accounts, land, equipment, everything else that you would be dealing with. So you may get to that number faster than you think. There's some, I don't want to get too sophisticated. There are some benefits and tools out there available for farmers that farm and commit to farming over the next X number of years and multiple generations, but it's only about $1 million in savings. So it's not real significant when you get into the $7 or $10 million estates. But be aware, keep your eyes on the news. I'm sure you all are, but the estate tax will change. We're just incurring way too much debt this year with the virus not to see a change or modification in that. And even if you don't, through political action, the law that is in effect today sunsets in 2025. So it's going to go back no matter what, no matter if nobody does anything, to a $5.5 million credit in 2026.
Thank you. And this question might be duplicative, so if it is, then feel free to tell me you've already answered it. But
I've already answered it.
I know we have several attendees who are interested in transferring wealth while minimizing tax liability. So we were wondering what the key was to doing that. So is there anything else to add other than what you've already told us?
I can talk. Sure. We'll add something to it. So, yeah, I mean, some of the keys in this, and again, it just depends on what you're wanting to do and what the size of the unified credit is and what the size of your estate is. I've got a lot of clients right now that are getting things valued, closely held businesses, pieces of property, to transfer those out in 2020. So we've got this $11.4 million credit. And they may, if they, first off, if you've got an estate of $10 million or less total, you don't really need to worry too much about it now. You can go ahead and make the transfers whenever you want to. There may be reasons to make the gifts, but it's not necessarily tax driven. But if you've got a larger estate and you're concerned with the unified credit going down to $3.5 million next year, if you take advantage of it this year, you could theoretically give away $22 million. If you wait till 2021, that number may very well be $7 million, and you've just lost the opportunity to give away, $15 million. So a lot of clients are actually valuing things and making gifts of them and transferring them. And they're doing those. And, a lot of times what we'll do is we'll set up a LLC or a company to wrap around a business or wrap around an asset. I noticed, I was talking to everybody before the call started, that in looking at the survey results, a lot of the results had indicated that there were a lot of sole proprietors out there, that people hadn't set up companies to run their businesses. I would suggest you set up companies, even outside of the sophisticated tax stuff we're talking about now. It just buys you liability protection. It just buys you some peace of mind. You won't lose your home. You won't lose every asset you get if somebody gets injured on your business or on your property. So that's almost a no-brainer in my book, similar to the powers of attorney that we were talking about. But with respect to the transferring and saving wealth, if you set up a company and you have certain types of control provisions in that company that you could put in an operating agreement, and then you start to give away small interest in that company. So if you have $1 million company and you give away 10%, is that 10% really worth $100,000? Well, if you gave somebody $100,000, you had $1 million in cash, and you gave them $100,000 or 10%, well, yes, you just gave them $100,000, and that's what the gift value is. But if you've got a piece of property or a company or a business that's got restrictions, somebody else has got control, takes majority vote to do things, you've got all these limitations in an operating agreement or bylaws through a corporation, well, maybe that 10% isn't worth 100,000. Maybe that 10% is worth 70,000. So you can get a valuation expert, a CPA, that's got the right qualifications to come in and do what they call discounting. And that's either due to lack of marketability because there's restrictions in the operating agreement, or it's a minority interest and you don't have any control, just owning 5 or 10 or 8%. So there are options out there to reduce the value of what you're giving to be able to give more underneath that unified credit threshold, if that makes sense.
Thank you. So you mentioned some trust throughout our conversation today. What are the benefits of putting property into a trust?
There's a lot of benefits to putting property into a trust. So, my practice over the years has changed a good bit. I used to recommend to clients always, a couple things that have changed. One of the big things that's changed, I used to always say, name your child as your executor, name one of your children as your executor. They're not going to charge you anything. It's going to be cheaper. It's going to be less expensive, more economical to do that. But over the years, I see families fight. I see families fight over very silly things. But of course, they're not fighting over a piece of furniture. They're fighting over a lifelong of, other issues. But I now recommend somebody independent to be the executor if you've got any kind of disharmony in your family. Maybe you're one of those blessed families that everybody gets along with everybody and there's no animosity or no issues. And if that's the case, and good for you, and you could probably get by with just having one of the kids being the executor. But that's something that I have seen over the years that I have changed my tune on. Another one is dealing with, when do I give kids assets? What age? Do I give them, at 21 or 18 when they're legal to get it? Do I trust them at 18 or 21? No, I don't trust them at 18 or 21. Again, maybe you've got the family that you've got the really responsible 18 or 21-year-old and you do trust them, and then great, good for you. Again, there's no one-size-fits-all estate plan. You have to look at what you're faced with and what you have. But, most of my clients, I see those ages creeping up, as to when they let the kids have real funds or the funds that they can do with them as they choose. So that's where a trust comes into play, to kind of get around to answering Candace's question. You use the trust to hold it. The kids get the benefit from it. You name somebody that you trust that shares your points of view as the trustee, how you want to raise your kids, how you want to, what lessons you want to teach them. And then they make the decisions as to what they need. They can pay for their education. They can pay for their health care. They can, buy them a car if they need them. They can give them money for a wedding if they need it. So your kids will be taken care of. They just won't have all that money in their hands to go blow it and do whatever they want with it until they reach a certain age. And it used to be very common. I would recommend 25, 30, and 35, which would, give them a third at 25, a third at 30, a third at 35. And if they did blow that first distribution, well, maybe they learned a lesson and, they didn't waste their entire inheritance. And of course, none of this happens until both you and your spouse are dead. So nothing happens to go down a generation until the death of both you and your spouse. But what I'm recommending now, instead of that 25, 30, 35, is I'm having them keep it in trust for the life of the child. Never giving it outright to them, naming maybe a sibling or somebody that's going to be pretty generous with distributions if and when the child needs them. You don't want the child's hands tied, but the beauty of holding it in trust is you can spendthrift it, which is a legal term, which basically just means you can keep creditors from getting at it. So any money you have right now, your creditor is going to be able to get to that. Any assets you have right now, if somebody gets hurt on your business, they can get to that. You own it, you earned it, it's yours. If your parents left you assets in a trust, they couldn't get to that. That's yours. It's protected. A creditor can't touch it. It's called spendthrifting. You can't spendthrift yourself. Some jurisdictions you can get away with it or try to get away with it. There are some laws, but you can clearly spendthrift a child. So you can protect the child from themselves with a trust by keeping them from blowing the funds or doing something stupid with a spouse. Getting a large inheritance and then immediately putting it in a joint account. I mean, that's really one of the worst things you could do, because the next day or that day, if there's a divorce, that spouse gets half of it. You can prevent them from doing things by using a trust. You can prevent creditors from getting at it. You can help protect your kids basically from themselves and from mistakes that they may make or things that may happen in their lives. They'll have their own assets to cover their own debts. At least they're always going to have that trust asset that's never going to go away or never going to be taken away.
And kind of piggybacking on that, you mentioned like LLCs and how they can help with liability protection, also with some tax issues. Are there any other benefits to having an LLC instead of a sole proprietorship?
Sure. I mean, with the so you can have LLCs are interesting because we're all used to them. Probably Candace doesn't remember practicing without LLCs, but I do. And used to be corporations were the entity that you use. Well, LLCs is kind of a morphing between partnerships and corporations. You don't have all of the corporate attributes and requirements and formalities, and you get favorable tax treatment with an LLC. So you can have a single member LLC that you set up for yourself and you have your own company. It's a sole proprietorship. It's still taxed on your 1040 on a Schedule C, and it's disregarded for income tax purposes. So it's really just the assets of the LLC are your assets, and you control them and do with them as you choose, but you run it through a company, and therefore, and you respect that company. That company has a checking account. That company pays its own bills. The company may have payroll. That company does everything that a company would do, but it's single-membered, so you own it, and it's reported on your 1040, so it doesn't get overly complicated. But if, as part of that company, a driver runs somebody over or somebody gets injured, visiting the business or doing something, they can only sue the company. They can't go beyond the scope of the company as long as that company is respected and ran properly. So, that LLC can go a long way to protecting your personal assets, your home, your retirement, other assets that you have outside of the business. So it's really another smart thing to do, in my opinion, is to get that LLC, do single member. It keeps it easy. It keeps it simple, but you get the liability protection. The other thing too with LLCs, if you've got more than one person as a member, then you're going to be taxed as either a partnership, or you can choose to be taxed as an association, which basically is a fancy way of saying a C corporation. Or you can make a tax selection with a corporation. A C corporation is just your run-of-the-mill standard corporation. Or you can make an election with the IRS and be taxed as an S corporation. Partnerships and S corporations are what they call flow-throughs. So the tax ultimately lands on the individual owners. They take the deductions, and there's a return that is filed, and you cover all your expenses, and whatever's left over, whatever the net income is, it flows through to the individual shareholders or individual members, 1040s. You pick that up in a K-1, and then you pay tax on it at your personal tax level. A C corporation, the company itself pays the tax. And then to get the assets out to the shareholder, it's a dividend. It's a little bit different through a partnership and a S corp. You distribute those assets out, and you don't generally pay tax on them because you already pay tax once. In a C corp, you have a two-tier tax. So that's another interesting dichotomy with an LLC. You get to pick and choose exactly how the entity is taxed. So you get to make the election. You get to decide whether or not you have one person or more than one person. And if it's more than one, you get to have a choice between partnership or corporation or S corporation. And right now, dividends from a corporation and the corporate tax are pretty low. That was one of Trump's recent tax acts, that he brought the corporate level tax down significantly. Well, one of Biden's proposals is that rate's going to go back up. So you may go back up to a 39% effective tax rate for dividends and corporate tax that is much higher than it is now. So another change that may come our way, depending upon how the election pans out.
Well, thank you. Those are all the questions that I had, but we'd be happy to take some questions from the audience if anyone has any.
If our attendees have any questions, please feel free to use the chat box down below and type your questions there for our panelists, and we'd be happy to share those with them.
Did I put everyone to sleep?
I know we did have one, Mike, and I think you've just covered everything so in detail. But one of the ones that I got was, how do you know that the trust is the right choice versus a straight will? And I know you covered trust and the benefits of that, but I think, are those two totally separate, or are those kind of combined?
Well, it's a good question, I think, because I think a lot of people struggle with that. And I think a lot of people struggle with the concept of a trust. It's like, what the heck is a trust anyways? I mean, no one really understands it. And all a trust is basically you put somebody else in charge of your money or whatever you put in that instrument, and you direct them to do whatever you want with it. So it's really limited only by, kind of your imagination. You transfer it to someone else, they manage it, and they do what you tell them to do. So if I get a client that comes in and let's assume there's no tax planning necessary. So let's assume that you don't necessarily need to have tax savings provisions, because if you do, then you're going to need a trust, because only certain things, you might want to qualify for a marital deduction, or you might want to get another benefit or allocate your GST. Those things are done with a trust. But assuming you're not there, if you've got a situation that you're going to leave everything to your spouse and your kids are in their 30s and you're comfortable with them and you trust them, nobody's got drug issues or nobody's got any spendthrift problems or creditor debt or anything like that, you could do a will that says, I leave it to my wife or my husband or spouse, and then if they're not alive, I leave it to my kids equally. And it's much simpler. I mean, you've got one document that's maybe 6-7 pages long, easy to read, easy to understand. You don't need a trust in that scenario. You don't have to worry about liability protection. You don't have to worry about holding things for the benefit of your kids, spendthrift issues. It's simple. Whoever you talk to about your estate planning, they should be able to guide you in that way. I don't use the trust for every single one of my clients. There are a lot that we just do simple kind of standard wills. I tend, if there is a trust, and a lot of my clients have trust because, they don't want to leave it outright to their kids. Either the kids are too young or there's an issue. So we hold it in trust. And then you can still put that trust language in a will, and that's called a testamentary trust. Or you can have, kind of an express trust, a document that lays everything out. And there's really no difference legally between the two, but in my experience and in my way of thinking, it's much easier to understand and follow if you've got that physical trust instrument versus part of a will. So it just kind of spells it out and makes it easier to comprehend and kind of track what's going on. But I hope I answered your question.
Yep. So we've had, Mike, a question from the chat box, and it is, once something goes into a trust, can it be taken back out? Land, for example. So
it depends. I mean, there's a lot, as I said earlier, your trusts are only kind of limited by your imagination. There are revocable and irrevocable trusts. So a revocable trust is, something that you may want to, that you can completely change your mind. There's very significant differences for tax treatment between a revocable and irrevocable trust. So an irrevocable trust is one that you can't change. It's irrevocable, short of, used to be you had to go to court and get a court order to change an irrevocable trust. But now you can do a family settlement agreement depending upon the facts and circumstance. So you might be able to tweak it and modify it. But generally speaking, irrevocable means irrevocable. You can't revoke it. You can't change it. So whatever you say in that trust controls. But you could theoretically say, okay, I'm going to put my land in the trust. And then if my trustee decides down the road that it makes sense to distribute that land back out to me, and your trustee is your spouse or your friend, they're going to pretty much, be talking to you, then they would have the authority to distribute it back out if they chose to. And that could be an irrevocable trust. So you could have that. What I tend to see, that would not solve any tax problems. That would not be a completed transfer because you could get it back. So it wouldn't save you any gift or estate tax dollars doing that, but legally it can be done. What I tend to see is somebody putting property into a trust for the benefit of their kids or the benefit of several generations, and then they can't get it back out for the benefit of themselves, but you might give somebody else some ability to modify the provisions, to do a little wait and see kind of thing as to how the kids are turning out, who's really working the business, who isn't, and give that discretion to somebody else.
Along those same lines, we had another question. Can you sue a trust?
Oh, yeah. Yes, you can. Yes, I'm defending a couple of them right now. And people sue trust. It's just a trust. Really think about it like another company. It's another corporation. It's another business entity structure. Corporations, partnerships, trusts, they're out there. So yeah, you can sue them. They can sue you. The beneficiaries can sue the trustee if the trustee does something improper, doesn't manage things correctly. There's a lot of fiduciary litigation that is out there where people are suing left and right.
Awesome. The questions are coming in now, so you've got quite a few, Mike.
All right.
The next one is, if you inherit a farm, what is the tax you would have to pay?
So generally speaking, unless you're in a state that has an inheritance tax, you generally don't pay anything. Now, back to what I was saying earlier with the estate tax, some states have an inheritance tax. Don't believe Kentucky has an inheritance tax. Ohio doesn't have an inheritance tax. Pennsylvania has an inheritance tax. West Virginia doesn't have one. Maryland has one. But at the end of the day, if whoever you're inheriting that from, if their estate was less than the unified credit amount, which is again 11.4 million right now, then they wouldn't pay any tax, and you would inherit that and no taxes due. And as of today, you get, this is significant, what is called a step up in basis. So basis is a tax term that is used in determining capital gain. So when you pay capital gain tax, it's really, a lot of people think of it, it's the difference between what you paid for something and what you sold it for, and that is your gain. The term basis is really what you paid for it, less any deductions that you've taken throughout the life of that asset. But it's the difference between your basis and your sale price, you pay capital gain on it. If you inherit something, you get what is called a step up in basis today, that all of a sudden your basis becomes fair market value at the date of the death of the person you inherited it from. So you could theoretically, I would say I had a house, say I had land in my family for multiple generations. I have it. If I sold it, I'd have a significant capital gain. If I died and left it to my child, they would have a step up in basis, could turn around and not pay any capital gain at all. So that's another benefit of inheriting. That's another thing that is on Biden's tax list that may very well go away as part of a tax change in 2021. But that's significant.
Our next question asks, would you put farmland into an LLC?
I would, yes. Yeah, there'd be no reason not to. Yeah, I would almost say you'd be a little remiss not to. I mean, there's just too many opportunities for accidents, problems, issues. I don't know what the kind of farm is. I don't know who all's on the farm. But yeah, I would put farmland in an LLC. I would not tax it as a C corporation though, but I would put it in an LLC.
Okay. Our next question is, has there been any indication from what the two presidential candidates would do with the current inheritance tax rate?
I think Trump hasn't said much. Biden, what he is looking at, what I have read and followed, is that he is looking to go back to what the estate tax was in 2009, which is a $3.5 million credit. And don't hold me to this, but I think like a 43% effective tax rate. It's marginal, so it increases based upon the size of the estate that you have. So that rate increases, but he's looking to make it a much lower credit and a much more onerous tax than what it is now. And it produces more tax dollars against people that have more than $7 million.
We've got a couple of questions, Mike, concerning nursing home care. How do you protect assets if one or both are in the nursing home? And I'm sure that can be a lengthy discussion as well, but we've had multiple questions on that.
Well, and it is. I mean, that's a whole area of law. And, a lot of people, are concerned, and rightly so. I've got two parents in nursing homes right now. So it's an extremely expensive proposition. And what's interesting is, Medicaid will consider their average, like Medicaid cost for a nursing home, somewhere around $3,500 a month. Your private pay nursing home care is $10,000 to $12,000 a month, $8,000 to $12,000, depending on where you're looking at. It gets really expensive, and you think of multiple years, it gets crazy. So just a few things on that, and it is a lengthy discussion, probably beyond the scope of this conference, but you're going to want to, if you are concerned about that, and if you think that that might be an issue in your life, and you've got assets to spare, so meaning that you're not living on everything you make and don't need all the cash flow that you have, you could give away some property. Land, it was a good example, because you may not be earning anything on the land. It may just be something that you own in your family. And if you wait 60 months, there's a 5-year look back before you have to apply for Medicaid, then that will not be brought back into your estate, and the gift will be respected. If you make a gift and then you have to go on Medicaid within that 5-year period, they will bring back effectively the value of what you've given away, divided by that $3,500 number that I kind of said. That's not exact, but then they'll give you what they call a penalty period, that you will not qualify for Medicaid for X number of months based upon that division. So if you want to qualify for Medicaid and you want to save some of your assets for your heirs, you're going to want to talk to somebody, and then you're going to want to also think about gifting something that you can give away for, now, and then still have enough assets to live for the next 5 years, because you can't apply for Medicaid within that time frame.
Yeah, I think you covered it. I know that's a lengthy discussion. I've had grandparents in the nursing home as well, and that's one of their topics of mine that goes in there. Yeah,
it's tough, because it hits us all, and it's an expensive proposition. And it's you've got to figure out you really, if it's an individual, you can't have more than $2,000. And when you apply for Medicaid, you have got to have spent down everything else you have except $2,000. Then Medicaid will play. But you think about it, it's a federal program that we're all paying for, designed to cover people with no assets. So it's tough, but it can be done.
I think we've got a couple more, if you don't mind.
I don't mind.
We knew this was going to be a good topic, so thank you all for joining us and sticking on. I know that this is a kind of a follow-up to the question Becky asked earlier about land in its own LLC that's separate from your farm LLC, or do you kind of combine those?
I separate them. So almost always I have land in a holding company, in a holding LLC, and then I have operations in a different company. Now, what I'll do a lot of is I'll have land in a LLC that's taxed either disregarded if it's one person or a partnership if it's two. And then I'll have the operations maybe in an S Corp. The big, you get some certain protections and some benefits. But and then I have a lease arrangement between the two. So where one leases the other. Again, you're kind of trying to insulate the liability and exposure from operating the business and protecting the land, which is the real asset, from a creditor.
And that's another follow-up question that we've got. If farmland is under a LLC instead of a sole proprietorship, if someone sued the LLC, couldn't they potentially get the farmland as well?
If you sued the LLC, they could. So in your question, you asked if the farmland is in the LLC, you didn't reference where is the operations. So if the operations are in the LLC, then yes. If somebody gets injured on the farm, then yes. If the operations are in a different company, maybe a different LLC, I'd argue that you could hopefully protect that farmland.
All right.
Go ahead. No, you go ahead.
No, I was just going to say, if the panelist wants, or not the panelist, but the attendee wants to follow up to that, but I think you answered what they were wanting.
Yeah. And you guys will give them my phone. I have no problem for you guys out there that have a question. You'll get my contact information, I think, at some point. But, feel free to shoot me an email or give me a call. I don't mind answering a question or two on this kind of stuff. I know it's overwhelming.
Beck, do we have some more? Do you see some more?
Yep. So we had one attendee ask if they have no relatives in the United States, are there any different international inheritance rules that come into play?
Oh, yes. And that is way beyond the scope of this, this call. But the answer is yes. I mean, every country has got its own international laws. I mean, you've got some countries that have a completely different concept of the type of law that they practice. I mean, it's not even English law. It's like a whole different concept. What's interesting is, they have what is called an international will that is designed from one of the treatises that was entered back in the 60s, maybe the Hague Convention or something. But, you're going to have to look at if you've got assets in another jurisdiction, if you've got beneficiaries that are residents that are non-U.S. citizens, you're going to have to look at the impact of what you're doing. International trusts, foreign trusts get really messy really quick. You can expose yourself to more than 100% rate of tax if you've got a foreign trust and the way distributions are set up. So if you find yourself faced with that situation where you have international assets or international beneficiaries, you're going to want to talk to somebody and get some detailed advice on that, because depending upon the structure you have, it's going to make a huge difference in the tax consequences you face.
Okay, thank you all for the great questions. Please keep them coming in the chat box. Our next question is, what are the steps in closing an estate?
So basically, I mean, keep in mind too, estate administration is a state-specific kind of process as opposed to federal. So every state has got its own process. But generally speaking, to answer the question, you've got to basically accumulate all the assets, put together an inventory, pay all the debts, pay the taxes that are owed, file any tax returns that are outstanding, deal with any creditors that come forward that you might owe money to, either pay them or challenge them or address them somehow, some way. After all that is done, then you've got to make sure that you distribute the assets the way the will or the trust directs, which may very well be just moving into another trust, and then that trustee handles it. And then you do a final accounting explaining, all the money that came in, all the money that went out, everything you did, everything you spent funds on, and then you close that through the estate. I mean, that's your, run-of-the-mill, Cliff Notes version of estate administration.
The last two I think are very similar, so I'm going to try to combine them.
Okay.
But it basically has to do with if your farm is in a trust or your assets are in a trust, can the nursing homes take it?
Well, it depends. So again, trusts are completely different. So if you were looking at doing a trust that you did not want any, you wanted to qualify for Medicaid. So let me back up one step, and this gets confusing to people because they think it's a nursing home that's taking it. Well, if you go into a nursing home, just like any other business or hotel or whatnot, you have to pay them. So nursing homes charge you, that's your private pay. Sometimes some nursing homes, not all, accept Medicaid patients. And then they have a contract with the federal government where they will accept less money than they charge a private pay. So if you qualify for Medicaid, then you have to go into a nursing home. Some nursing homes will accept payment through Medicaid, and you don't pay them nursing home, the federal government pays them. So to answer your questions, if you have a trust that you're a beneficiary of, or you can somehow, some way receive benefits from that trust instrument, that will be counted as a resource by Medicaid, which means you will not qualify for Medicaid until there are $0 or $2,000 or less assets in that trust. You have to spend them down. It's a resource. If that's a trust that you have set up for the benefit of your kids or somebody besides your spouse, because Medicaid tends to combine the spouses as one, different rules. But if you transfer that and you retain no interest, then, and it's been 5 years since you made that gift, then that trust itself would not be counted. So you would not necessarily have the right to receive anything, but it wouldn't be calculated in as a resource in the Medicaid determination.
Thank you so much. I know that if any of our attendees have any other questions, we're going to hand it back over to Candace. But feel free to email. I know many of our attendees have Becky and my email, but like Mike said, we're going to post a presenter slide at the end. Feel free to keep them coming after the presentation tonight.
Yes, thank you. Thank you, Mike, for that really detailed explanation on a lot of different topics. I know we could not cover everything tonight, but that was a great overview. Hopefully it answered a lot of your questions. And thank you everyone for participating so much tonight. I really appreciate it. It was great to see some things that are of concern for you all. And that whole purpose of these webinars is to try to be able to benefit you and your business. So at the end, if you have any other questions, feel free to get in touch with me and Mike. Or if you have any questions about different topics, you can send those to Nikki, Becky, or to me. And we would love to take that into consideration as we plan our spring webinar series. We hope you can join us again in the spring.
Thanks.
Thank you all.
All right.
Beck, you want to tell them bye, or you want me to?
I can. It's fine. Let me share this screen real quick with our presenters' contact information. Let me get this. So you have their email addresses if you want to get in touch with them. I just want to thank everybody for joining Nikki and I tonight for our second legal planning webinar with our friends from Steptoe and Johnson. We really do appreciate Candace and Mike's insight tonight on estate planning and land transfer, and their great insight into all those things. As Candace said, we do hope to continue this webinar series later this coming spring. So if you have any legal issues that you'd like to see us address, we'd be happy to take that feedback in and prepare something for you later on. Again, thank you so much, and I hope you have a great evening.
Thank you all.